You have to have a resiliency to never give up and keep fighting. I mean, I know that it's kind of, um, you hear the story of so many, so I don't know who your heroes are, who you look up to, but just if you study history and at that time, when I was younger, I had never read a book before in my life, and I immersed myself into reading and studying, people that have changed the world, Abraham Lincoln, I mentioned Warren Buffett, Jeff Bezos, Elon Musk is a huge, I love Elon. He's one of my heroes. So, and if you look at the trend with all of these people, they all have this resiliency to never give up and put their life on the line to get something to make it happen.
Welcome to the Real Estate Mogul M.D. podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable, real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Joining me today is Angelo Christian, CEO of Christian Financial and one of the nation's top mortgage and real estate strategists. He's helped thousands scale from one property to a full portfolio. And today, he's breaking it down for physicians. Here we go. Angelo, welcome to the show, man. We've waited a long time and we finally got you here. How does it feel?
Awesome, man. Thank you so much for having. I'm super excited and appreciate you for even thinking of me and inviting me to come on.
That's awesome. I'm excited to talk about something a lot of people are so interested in these days, and it's money. And it's more than money, it's leveraging money. And that's kind of what gives us velocity in most of our investing plans here. Right. So I want to get into that a little bit. But first, tell us a little bit about how you got started into real estate and mortgage banking.
Yeah. So it wasn't by design. So I grew up in a very, humble upbringing, a very poor family in Texas, in Houston, struggling to make it. My father left my mother when I was in the 6th grade. So I dropped out of middle school to take care of my family. I had 4 brothers and sisters. Wow. So the idea of even owning a business, running a company, doing any of that just was completely unfathomable. And I was also, I weighed 400 pounds. I was 200 pounds overweight. So just no future, no direction. And then, a lot of bad things happened to us. We lost our car. We lost our house. And it forced me to hit rock bottom. I had a heart attack when I was 18 years old. And the biggest catalyst to me was, the movie Rocky. And that movie was the turning point for me that helped change my life. And it gave me a reference and precedence that if anyone can change and become, on top of the world, that you can do it. And it gave me the positive proof that could actually happen. So that was like the catalyst to help me to get in shape, change my diet, lose the weight, go back to school. So I went to school for finance and economics, studied Warren Buffett. And I ran into a very old friend of mine that was actually in mortgage, and I hadn't seen him like in 6 years. And this is before the subprime crash. And he was living on top of the world, just, making big money, big life, the whole thing. And at that time, I didn't even know what a mortgage was. So I came and worked with him for a little bit, shadowed it. And the name of the company at that time was AmeriQuest Mortgage. It was the biggest subprime lender in America in the 2000s. So anyway, learned the business, fell in love with it. They were the biggest subprime lender. They had a call center set up. They were doing basically like hard money, subprime cash out loans. And they had a very systematized, very organized model that I fell in love with. Not the products they were doing, but the system, the structure with the call center made a lot of sense to me. So I went out and did my own brokerage and went through the subprime crash and then kind of scaled and pivoted through the market as it ebbed and flowed. When we had the crash, we got out of subprime mortgages, got into FHA, and just kind of, toggled around and pivoted with the market and kept growing. At this time in my career, I was just doing residential mortgage. So I was not doing hard money. I was not doing commercial. So from 2005 to 2015, it was just residential. So that's kind of like the backstory that helped me to kind of build the foundation for the whole company today.
And how did you go? I guess, I mean, such a struggle there. Holy cow. There was a lot of stuff you just put into that, that intro there, and the challenges in life and overcoming that. How in the world did you go from struggling early on to helping thousands of families become homeowners and investors? Like, how does that happen?
Man, you just, I mean, you have to have a resiliency to never give up and keep fighting. I mean, I know that it's kind of, you hear the story of so many, so I don't know who your heroes are, who you look up to, but just if you study history and at that time, when I was younger, I had never read a book before in my life. And I immersed myself into reading and studying, people that have changed the world, Abraham Lincoln, I mentioned Warren Buffett, Jeff Bezos, Elon Musk is a huge, I love Elon. He's one of my heroes. So, and if you look at the trend with all of these people, they all have this resiliency to never give up and put their life on the line to get something to make it happen. So I've felt like, even though I've never known these people personally, that if I embodied those character traits, that I could hopefully have a shred of that. The thing is that developing the right habits, changing your focus, controlling your focus on what you're going after, setting up goals. Even still to this day, man, I work 7 days a week. I work, my wife, I think she calculated I'm working about 90 to 100 hours a week still.
Oh, wow.
So, and I mean, I don't take days off. When we go on family trips, I'm still working. So it's just, you're kind of, I mean, some people, like, either you're wired like that or you can adopt those traits and, embody that. So I was not wired like that. I was forced into it, and then it just kind of compounded.
Interesting. I just want to touch back on something you mentioned earlier, subprime, just for the listeners not aware of that. I'm sure a lot of us have heard that, but what does subprime mean to you?
Yeah. So subprime is basically, at that time, in our history, let's say I'm 44, I feel like that was when I was 22. That is a loan that basically is not a conventional loan, like you can go get, to get from a bank, where there's either blemishes or issues with the credit, and it's not underwritten by Fannie Mae or Freddie Mac or FHA. It's usually a private investor that's making that loan, and it has a higher premium, a higher price. Give an example, someone that wants to buy a home for $500,000, they got a 540 credit score. Obviously, they can't get approved from a bank with that credit score. So at that time in the era, in the 2000s, early 2000s, you could go and get a loan, even get 100% financing. Now, you didn't get the going rate, which was 6%. You got an 8% or 9% rate, and you were charged a few points. But a lender would make that loan to somebody in that situation. So that was called a subprime mortgage, because prime means, prime, like prime beef, like grade A. Subprime is below that, which is basically a higher risk, but also a higher return to the investor. And it created a several $100 billion, $1 trillion market at that time.
Mm-hmm. And then lost.
Yeah.
That was a big swing.
And, I mean, then obviously everything imploded. And it's kind of interesting. Like, I was so young, man, when I was in it. Like, I didn't even know what was going on. Like, my boss said, hey, go sell this, go do this. And I'm just following order. I didn't conceptualize what was happening. You know what I mean?
Yeah.
So obviously, I'm sure you've seen the movie The Big Short. Mm-hmm. Yeah. And that's kind of what that whole thing was about.
Wow. Very interesting. So away from these subprime deals, the last question I have on that, actually, Angelo, is, does subprime have any relation to the asset itself, or is it just the borrower?
At that time, no, it didn't have anything in relation to the asset. It was more based on the credit grade, and then the income verification. The ability to repay was not really there how it is today. Mm-hmm. But this was all for like standard, 1 to 4 family properties. The properties had to be habitable, so it wasn't like a bridge or a fix and flip or anything like that.
Mm-hmm. Interesting. Now, back to the other stuff. I want to talk more about borrowing. And physicians in general have a higher income rating than a lot of people out there who are, going out for loans. So what's the biggest mistake that high income professionals like physicians make when applying for a mortgage?
I think that, I'd say obviously checking all their options. I mean, of course, they can probably get a loan from their bank. But like a physician mortgage, like we offer a physician loan, you can get 100% financing, no PMI, up to $2 million. And a lot of physicians, they're not aware of that. You can get a low 30-year fixed mortgage, no mortgage insurance, and get 100% finance. They may go to their bank and their bank wants them to put 20% down. So I definitely say check your options. And then depending on, where you're at, credit wise, we get these calls all the time. I got a customer that's closing today in Hawaii that's buying a $5 million house, and he co-signed for his son. He's a CEO of a company, makes great money. But his son didn't make the student loan payment, so his score tanked to 623. So his bank told him that he couldn't get a loan. This is a high profile CEO, makes a lot of money buying a $5 million home, putting 30% down. Private lenders like us also have asset-based loans for high net worth individuals that maybe there was an issue with the credit that go beyond that. You can still obtain financing and get a great 30-year fixed mortgage, even if you don't have an 800 credit score. So a lot of times there's situations like that where there could be an issue that pops up. We also cater to a lot of high net worth self-employed people. Small business owners. Small business owners, self-employed, have a very hard time getting funding through traditional financing because of the way that they run their how they run their books and all that stuff. Mm-hmm. So if you're a small business owner, we are the small business self-employed expert. We have all the self-employed products.
So this situation where you mentioned a different product where you said asset-based, are you referencing something similar like a DSCR loan then?
Yes, but for owner-occupied.
Okay.
Yeah, okay. So DSCR in its nature is for an investment property. We have those for primary residence as well. So we can go up to a $30 million home loan for a primary residence or a rental property. The DSCR is just underwritten off of the cash flow if it's an investment property, but the primary is obviously underwritten many different things. It could be their bank statement, their 1099, their P&L, their financial statement, or we even have no documentation. So just depending on the situation.
It makes me think, where in the world do you get this? You're a private lender. Where in the world do you have the capacity to fund like $30 million deals, and that just wouldn't shut you down the rest of your branches? Does your funding come from a fund that's built, or you have other sources? Tell me a little bit about that, because I don't know anything about that.
Yeah, so the way that it works, there's two things. On the standard lending side, the conventional primary residence, those loans do not stay on our balance sheet. Let's say we're going to do a $20 million loan in Miami. That loan is sold to an end investor within 3 weeks after we close. We don't have the capacity to keep that size of a loan on our line, mm-hmm. right? So it's called a warehouse line of credit. So that loan, as soon as we fund it as the lender, will get sold off to a bank or an end buyer that buys that holds that debt. Now, a commercial or hard money loan will stay on our balance sheet, and those loans are usually under $2 million or whatever, and we'll keep the spread on those and the points, and then we'll service those loans because it's something that gives us a higher yield. But those loans are much smaller on the private commercial side versus the standard jumbo mortgages.
Interesting. So when you keep the spread above your whole you said is a wholesale line of credit?
Well, yeah, on the commercial private, let's just say our cost of funds is 7%, mm-hmm. and then we're charging 11% on a bridge loan. So mm-hmm. we're capturing 4% on the spread, and then we might charge 2 points.
Yeah. Makes sense.
So we'll do that on the private bridge loans, and that makes a lot more sense. But we don't have the capacity at this time to fund like a $20 or $30 million hard money loan. Mm-hmm. That's very hard to pull that off.
Yeah. You mentioned, we talked briefly about DSCR, and I heard you say conventional. There's this other thing out there called jumbo. And for physician investors, can you break down those three things for us? The
Yeah.
DSCR, the conventional, and the jumbo?
Yeah. So one of the what's emerged in the last 10 years is non-QM, the non-qualified mortgage, and DSCR is under the umbrella of non-qualified. And basically, after the crash, Dodd-Frank came out and basically standardized, put a partition between conventional qualified mortgages and then non-qualified. So the non-qualified is more tailored towards a private investor that doesn't go through Fannie Mae or Freddie Mac. The DSCR specifically is for investment properties only. It's not for a primary residence. And it allows the investor to purchase the property with no employment, no income check, basically just needing 15% or 20% down. You can close in your LLC, so it doesn't report to your personal credit. And it's a 30-year fixed loan that kind of is very close to a conventional rate. You can buy as many as you want. There's no limit, like with Fannie Mae and Freddie Mac, where you're limited to 10 mortgages. With non-QM DSCR, you could buy thousands of them because it's just underwritten off of the cash flow. What they're looking at is, okay, what is the rent of the property relative to the payment? And there's some products that want it to be 1-to-1. That means that the payment has to equal 1 to the actual rents received or market rents coming in. And there's some that have no ratio or negative DSCR, just depending on the situation. But basically, it allows investors to close in the LLC, scale, accumulate more properties, and still get great financing, without having to deal with all the hoops. It's very hard to get loans through banks and Fannie Mae and Freddie Mac. And then you can also do blanket loans. You could bundle multiple properties into one DSCR. So let's say you bought a tranche of 15. You could bundle all those into one DSCR loan. So that's DSCR versus conventional. It's a Fannie Mae, Freddie Mac product, usually a little bit lower interest rate, but you have to verify employment. You have to verify credit, tax returns, W-2s. You ran through an automated software underwriting system that determines your eligibility. It's not an actual underwriter that's reviewing your file as a manual review. The computer's making a decision, and that loan ends up getting shipped off to Fannie Mae or Freddie Mac after it closes. And there's limitations. You can only have 10 properties total on your credit report that you can own with Fannie Mae or Freddie Mac. What's the benefit? The benefit, you might get about 0.5% lower rate than a DSCR loan, but you can't close an LLC with a conventional loan. It has to be in your primary name, and it does report to your personal credit. So those are the difference between the conventional and the DSCR. The last one you asked about jumbo?
Mm-hmm. Yes, sir.
The jumbo is when the loan amount is over the conforming limit. Right now, the going conforming limit's like, 800,000, 770. So if somebody wants to buy a $2 million home in San Diego, they cannot do a conventional loan because the loan is greater than the conventional loan limit. So they have to get a jumbo loan because it's $2 million. It's not 780. So there's a whole market for jumbo investors that buy those loans. And basically it's just a bigger loan amount. Now, their interest rates are slightly higher than conventional because it's more risk. We have so many products revolving around jumbo, like you mentioned, jumbo physician, jumbo self-employed, jumbo hard money, jumbo no doc. So depending on the person's situation, we can tailor the underwriting and the processing to meet the investor guidelines and meet the borrower, what the borrower is trying to do. So what we try to do is, okay, what's the customer situation? Okay, he can't show taxes. He's just got bank statements. So we're going to do a jumbo self-employed loan. Or it's a physician. We're going to give him a jumbo doctor loan. So, but yeah, they're really great loans, man. And it just depends on the person's situation to see what we can do to mirror match them the best to the investor,
Yeah, yeah. You mentioned Fannie Mae and Freddie Mac. Who in the world is Fannie Mae and Freddie Mac, and why do they get to make all these rules that make it difficult for us investors?
Yeah, I mean, so it's kind of the backstory, I think you could look it up, but I forgot what Fannie Mae stands for in Freddie. It's a long thing.
Yeah.
Basically, a federal housing agency. And the idea behind it was, and this was set by, actually Roosevelt started it. And so obviously, if you think about it, I mean, the mortgage industry is probably one of the biggest industries on the planet, and trillions of dollars. And back in the day, when you went to the SNL, the savings and loan to get a loan, you sat down with your banker like in 1910 and talked to him, did a handshake deal, and you bought your house, got a loan. And obviously, as America was growing, they noticed that there was a liquidity event where we're running out of money and banks don't have the money. And so FDR created the Federal Housing Administration to help to facilitate the flow of capital and to originate mortgages. So all it is basically for conventional loans only, a conduit or an outlet for banks, credit unions, mortgage lenders to originate and sell their loans to. So got to give you an example. Let's say that a bank originates $100 million of conventional loans, right? They need to get their money back. It's on a line of credit. So they will sell those loans to Fannie Mae, that $100 million, to replenish their capital. And then those will stay on Fannie Mae's books. But Fannie Mae is the end buyer of these loans. They establish the covenants and the guidelines for what the lender as me can originate. So like if they say you have to have a 620 or higher credit score, I have to follow their requirements for them to purchase the loan. Otherwise, they will not purchase the loan. So since they're the end investor, they call the shots because they're the ones that are buying the debt.
And are they I mean, I know I could probably Google all of this stuff and find it out, but Fannie Mae and Freddie Mac, are they government entities?
Well, they're considered government sponsored agencies. Yeah, it is a government, like FHA. So there's FHA, which is the Federal Housing Administration. There's USDA, the United States Department of Agriculture. There's Veterans Administration, and then there's Fannie Mae. These are all government sponsored agencies, and they all play different roles. Like the VA and the FHA is not actually buying the loan. Their role is to ensure and guarantee the loan. So like if the FHA loan is sold off in the secondary market to, let's just say, Goldman Sachs, but then the FHA is actually guaranteeing the loan for the performance. If it goes into default, they'll pay off Goldman Sachs. Whereas Fannie Mae and Freddie Mac are actually buying the loans.
So it's tax dollars actually buying the loans.
Yes. Yeah. Like hundreds of billions and billions and trillions and
lots and lots of money. Lots of fake money, because the world of digital versus actual cash on hand, that separation of reality they're not equal amounts. And then we're talking about ledger, off ledger, a whole nother podcast that we could go into that one. Yeah. But bouncing back to real estate, and why this is important, real estate, Angelo, is because we leverage capital in order to scale. And many of our listeners want to scale into multifamily or commercial. What advice do you have when it comes to financing those bigger plays?
Yeah, I'm glad that you're talking about it. I think it's a really important topic because a lot of my clients are investors and entrepreneurs and business owners, physicians, and they all want to create mailbox money or some type of extra cash flow. And real estate, in our opinion, I believe, is the conduit that allows that to happen. But you have to be set up properly. From the entity, the legal, the tax, the corporate, the funding, the whole thing, right? So, and we've helped a lot of our investor clients scale. The biggest thing that I think would be either to, in my opinion, there's, of course, depending on what your approach or what your goals are, either you join a network such as yours or other podcasters and you align yourself with the right cabinet. You got to be with the right team to be successful. Like, for example, on the lending side, a lender that has the products that can get you the best rates, fast closings, abundant buffet of product, so you can get that loan. But like joining a syndication or a group to help you, like if you want to buy a 200 unit, like and that property is $80 million, realistically, you're probably not going to be able to pull that off by yourself, but you could do it through a syndication or joining a network or group to help you to arrange the financing, the capital, and then you have shares or equity into that large property and kind of scale your way up. A lot of my clients, what they've done is they've either partnered or they've done a JV on bigger projects, or some of them, they start small. They start with their first single family home and they just kind of scale up. One of my biggest clients in Boca Raton, he's been doing it for like 28 years. I mean, he has thousands of properties. He came here from Lebanon with nothing, and he bought his first rental property. Now he's got like 7,200 doors. So I think it just depends on what you want to accomplish. If there's a certain income goal or metric that you're looking to do, but you definitely want to keep your credit as high as possible. I mean, credit is very, very important. You want to have at least 750 or higher. The other thing that lenders look at is when you're trying to get these big loans is, what is your experience and track record? Like, there's no lender in the world that's going to give somebody an $80 million loan and they've never owned anything over 100,000 or they bought their first house. And lenders don't think like that. Lenders like, well, if I'm going to give you a $5 million loan, show me how many other $5 million properties you managed. You know what you're doing. So having the right property manager, the right team in place. So, and they want you to kind of ratchet it up, slowly, unless you are part of a JV or a syndication that has a very powerful track record. So they look at track record. The other thing is liquidity. Liquidity is very important. Lenders don't like to make loans to people that at 100% financing. It doesn't make a lot of sense for a lender to do that, because if the sponsorship doesn't have any skin in the game, the likelihood of default is going to skyrocket. And it's proven over and over. So I think having realistic expectations that you are going to have probably 20% capital that's fair to assume that. So I think these are three important things that need to be focused on.
Very interesting. And I heard expanding your associations right out of the gate to help. So leveraging capital is a big piece, but leveraging relationships is huge too, to expedite you in that journey. Partnering with operators who have that proven background or that proven experience helps you get there.
Right.
What is it? So if a lot of people go from single family to multifamily, if they have, 15 units or 20 units, whatever, in the single family world, and they want to bump up into that commercial world, it's 6+, but say in the 20 unit, somewhere around there, can you leverage your experience in the single family world, in the 15 units or whatever, to show your experience to get into that 20, 40, 60?
Yeah. I mean, that's something that there's a lot of people that do that because, they realize that multifamily, let's just say it's a 20 unit, from a logistical and financial, it makes more sense to manage that than versus 12 properties spread out all over the city or the state. So that, as long as the transition is not very, like, let's just say over by 200% or some crazy, like, let's say you have six single family homes and you want to buy a 20 unit, that's practical. But if you have 6 family homes and you want to buy a 200 unit, that is where lenders are not going to do that unless you partner up with a very strong operator. So, and you can even use, there's a lot of ways that, and I'm sure you've heard, using pledging your current properties, or you're doing a cross collateralization. You take your existing portfolio. Let's just say that those 6 properties are worth $2 million. You can use that for collateral to purchase the 20 unit. So that's another very strong thing. A lot of people think, well, hey, I don't have the 20%. Well, if you have equity in your properties, you can use that equity to purchase the large multifamily. We do cross collateralization all the time.
Yeah. And if that equity is in, when you cross collateralize, that you're not actually removing the money, it's using it as a what if or a in case scenario. And now, when's the right time to pull equity out of a property and reinvest? So I've got a property, maybe I've passed the prepayment penalties and it's been sitting there. I've got this equity on paper, but it's trapped. I want to release it. What are some of the mechanisms or tools that you use to say, hey, now's a great time?
Yeah. I mean, so what a lot of people, I'll tell you this, what most people are doing, a lot of people got their loans a while ago when rates were low. We get this call probably 80 times a day. Hey man, got this rental property. It's worth $1 million. I owe 300. I got a 3% rate. I'm not touching the first because the rate's too low. I mean, you probably hear this every day.
Mm-hmm.
Well, what's come out, what's been created is a second lien HELoan or HELOC, and you can even do stated no doc on investment property. So let's say that, use an example, the property is worth $1 million, you owe 300. We can give you a second mortgage behind the first. You don't have to touch the first, so the prepayment penalty is never touched. The first mortgage rate's never touched. We'll give you a line of credit or a second mortgage of $500K behind the first mortgage, so you can take that to do your investments. And you can get a 30-year fixed loan. The interest rates right now are starting at 7%.
Oh, wow.
Yeah. So, and then you can either, if you do a line of credit, then obviously that works just as a revolving line, and there's a 10-year draw period, or you could just do a 30-year fixed HELoan, which is just a cash out mortgage. So everybody right now that I know that has equity is doing that.
Interesting.
Yeah. And it can be for your primary residence or a rental property.
And you said HELoan, not HELOC.
Well, there's two of them. There's a HELoan, which is it's a cash out mortgage. There is no line of credit feature. It's just you lump sum payout, you repay. So there's a HE, HE loan. It's called HELoan. And then the other one is HELOC, which is line of credit. And that is where, okay, if you pull money out, you can pay it back, and you can keep going back and forth for 10 years and draw and pay back. So some people like that feature. Now, those are harder to qualify for. They have more stringent requirements for a HELOC with the credit, income, and debt ratio versus a HELoan.
Interesting. Last question I have for you is, what's the difference between someone who owns one property and someone who builds a $100 million portfolio?
And as far as the difference in what, their psychology, or
who they are. What does it take to be that person who owns one person or one property to be then a person that owns $100 million worth of property? Who do you have to become to be that different? There's several things because it's funny that that's a very good question, because we do our customer base is both of those people. Mm-hmm.
And I've gotten to witness. I have one of my clients is actually, I got to go meet with him after this show. He has a $240 million real estate portfolio, the biggest landowner actually in Galveston County in Texas.
Wow.
And I have the next customer next to that that's just trying to get into this and start it. And the biggest thing that I see, obviously, of course, is experience. But there's a tremendous amount of confidence in the large investor. They have this amazing faith and belief in what they're doing. But their ability to take on risk, they're not scared. Okay. They can handle risk that's calculated. And I see like the entry level people that are starting, they're very nervous. They're very worried. Their focus is on, what if it goes wrong? What if I lose it? What if I can't make it? So their belief in themselves is way lower than the person that's built this massive empire, and rightfully so. So I think that, having the confidence, and how you build confidence is obviously through experience. And so putting yourself in these networks, going out and jumping into the water, and, it's okay to fail. It's not, don't be scared to fail, but learn the lessons and get yourself around the right people so that the failure isn't catastrophic. Because, what you don't want to do is you don't want to bet the farm and lose the farm. That's why you put yourself in the right group, so you can be successful and you can minimize, the hemorrhaging of the risk that you take. But all the guys I know that are super wealthy, far wealthier than me, their ability to take on risk is just like, once they can look at something, make a calculation. Hey, yeah, I'm in it or I'm out, and then allocate the capital, and then let it ride, So, and people that are new, they're not sure. They doubt themselves. They don't want to take it. They're worried about everything. I don't know if that answers your question.
Yeah, I love it. Actually, it made me think sometimes I'm actually scared how unscared I am when I have faith in a process. You know what I mean? When I have that decision, I make the decision. It is just there, but that means a lot, being able to make that decision and pull the trigger.
Right.
So the listeners, being a physician, they're trained to mitigate risk. They don't want to take things that they know aren't going to prove 100%, because that's my life, that's your life, that our listeners
Right.
Work with. So making this mindset shift to get away from that, Angelo, you share your experience. Do you have a real estate university and coaching programs, right? Do you share these kind of mindset shifts? Is this the kind of stuff that you talk about?
Well, yeah. So, I mean, obviously our core business is lending. So we lend nationwide, like I said, commercial, residential. We have a real estate university. Now that's designed to become a loan officer, a lender. So people that want to get into the business, now of course anyone else can attend it. Real Estate University is an online course. It's over 1,000 hours of content. I built it. It took like 3 years to build, but it's designed for people that want to get into the industry and become a loan officer. So if somebody wants to learn about mortgage or products, how to become a closer, how to generate leads, that type of thing, that's what Real Estate University, and that's been there. That's been in existence for 8 years now. We have over 200,000 students on that.
And where can the listeners find more information about you and that program? Yeah,
so they can obviously go to our website, officialangelochristian.com. We're very big, very active on social media. Angelo Christian Mortgage on YouTube, Instagram, TikTok, Facebook, realestateuniversityonline.com. So, we'd love to hear from you guys. We have great rates, great service. We're open 7 days a week. Anything that we can do to help add value.
Open 7 days a week because Angelo works 7 days a week. Yeah. If I have to, you are. That's what you tell the team when you come into the office, right?
What's that?
That's if I have to, you have to. That's what you tell the team when you come into the office.
Surprisingly, I don't make my team work 7 days a week. I don't expect that. I don't know, man. Like there's always, how it is when you run your own business, there's always stuff to do. Mm-hmm. And whether it's you're either working on the business or you're working in the business. And so I don't want to burn my team and wear them out. So I try to limit, just, Monday through Friday for them. If they want to work the weekend, I'll pay them extra or whatever. But, I noticed that when they come back Monday, they're refreshed. It's usually they're in a better attitude. So,
yeah. And I know you talked about focus earlier, and that's definitely a huge piece when there's so much to do. Yeah. It's what you're focusing on. What are you doing is what's really important. Right. Hey, what's one action you would encourage every high income earner to take in the next 30 days to move toward ownership and freedom?
One action. I mean, I would say, obviously, invest in real estate. Join a mastermind, somewhere where you can find access to great deals. Align yourself with the right group. I mean, the right mastermind group. I think where you can get. I'm not going to call it insider information, but if you're in the right network, the right club, the right team, it's going to make all the difference because everybody's chasing yield, right? So if you're just looking online to buy properties, you're not gonna find any great opportunities. Mm-mm. You're gonna have to. The good stuff that I see is either off market or banks are unloading on their balance sheet. If you're friends with a banker that's got a portfolio of stuff they want to sell, those properties usually have a ton of equity. Yeah. And that's where the opportunity is you align yourself with the right group. Like we have an REO for sale of foreclosures, right? Well, the stuff that we're selling is at 50 to 60 cents on the dollar. You're going to be far better off because it's not listed to buy that versus something that's on, the MLS. Mm-hmm. So put yourself in the right environment so you can, so you can win, so you can be successful.
Yeah. Yeah. Success leaves clues. And I think if you were to rewind this interview back, there are things that are mentioned repeatedly. So I think that was spot on. Great question. I know I'm putting you on the spot, throwing these questions out there, but man, it's been great, Angelo. Yeah. Absolute wonderful conversation. There's so much knowledge here. So thank you again for your time.
Of course. No, awesome, man. Thank you for having me. It was great to meet you, and we definitely follow the channel and appreciate everything. If I can help anything else, just let me know. It's great. Thank you so much.
All right. Thanks, Angelo.
Later, man. All right. Bye-bye.
That was packed with fire from Angelo. So many things, so many topics we could have carried on for another hour, I bet. But here are a few things that I took away today. Real estate is a vehicle to scale wealth, especially if you know how to leverage financing. DSCR loans can unlock doors for doctors looking to invest now. And you don't need to wait. You just need to act with education and guidance. The largest takeaway I had and repeated several times is just expanding your associations, surrounding yourself with people who have already done what you're looking to do. It's so important. And thank you for doing that here on the Real Estate Mogul MD. Until next time.